Let's take a look at using cash value life insurance as a vehicle for investing in real estate. So, for example, let's say we've got a policy that we put out, and look at our other videos to get a more in-depth look at policy design and structure. But let's just say that we have $300,000 in a policy. Now, by getting that policy, we know that that means that we're getting a compounding rate of return of a minimum of 4% up to about 6% with the dividend rate. So the companies we work with have consistently returned this dividend rate. So you're getting just about 6% in your account every single year. So let's just say for this fictitious example that we're not contributing to this policy anymore, meaning we've paid into it for a number of years, or we had a lump sum, we paid the $300,000 in, and we're not adding any more to it at all. Now we want to make some investments in real estate. So let's say over here we've got a property, and that property has a price tag of $100K. Again, just round numbers for argument's sake. We could, if we wanted to, go and get a bank loan and try to orchestrate this purchase. Or we could look at an example where some of our real estate investors will actually look at funding using their policy to purchase property as well, because one, they may have too many private mortgages out, too many bank mortgages, conventional ones that they cannot apply for anymore, or they just have the cash and they want to put it to good use. So in this example, we'll talk about sort of an analogy for loaning this out. And so if I wanted to purchase that property, I have $300,000 in here. Instead of withdrawing that money out and affecting this compound growth, which is the last thing we want to do because we're making great returns on that each year, we want to leave that intact. So the insurance company says, okay, well, we know that at some point we've got to pay you that death benefit. And this $300,000 probably bought us a death benefit of, I don't know, let's just say that it's $3 million. So we know that when we die, our spouse or our children are going to get a net cash tax-free death benefit of $3 million. So the insurance company knows they have to pay that at some point. So they go, look, we'll loan you out any amount of money up to this $300,000 if you want to take it out and use it elsewhere. So what they'll do is they'll say, okay, well, why don't you take the $100,000 out from us as a loan? So you take the policy loan for $100,000. Now, again, this isn't your money technically. It's the insurance company. The insurance company is loaning you the money backed up by that death benefit that they have to pay you. And they are collateralizing, knowing you've already got that money in your policy, because they'll only loan you up to the amount that you have in there, or just under that, about 90% of it. So you take that $100,000 and you purchase this property. Now, in this fictitious example, let's assume that we are going to get a cash flow rate of, let's call it somewhere from like 6 to 12%. This is the rate of return we're going to get. Cash flow from the rental property. Well, the question is, what is the insurance company going to charge us in terms of a loan, right? There's a cost to purchasing or using someone else's money. And in this case, it's a loan, right? Just like you would pay a loan interest back to a bank or any other lending source, you're going to pay the interest to the insurance company. Again, it's not your money, it's the insurance company's money, just collateralized by the money you already have in here. So on average, the insurance company charges somewhere between 5 and 6% simple interest to take that money out. Well, what does that look like in actuality? Well, if we took $100,000 and let's call it a 5% interest rate. Well, that would mean that we are adding, basically we're charged $5,000 per year on that $100,000 balance, right? So if we were going to look at this as if we were our own bank and we wanted to pay ourselves back that, what would we be paying? Well, let's just take 20 years for an example. So let's say that we wanted to fund this, pay this thing back for 20 years. So we have $300,000 in our policy. We take a $100,000 policy loan. We purchase this property and we go, okay, we're going to set our own terms here. So I'm going to pay this $100,000 plus the 5% interest back over 20 years. If I break all that math out, including interest, your payments are about $660 per month, right? So call this quote unquote your mortgage. Basically, the amount of money that you want to pay if you wanted to return this back to the insurance company. Again, you don't have to. The insurance company is going to keep accruing that interest each and every year if you don't pay them back. But if you wanted to be a good banker, you want to pay yourself back just like you're loaning out from any other institution. So you would owe $660 back. So let's just say fictitiously that I'm going to make an 8% return on this rental property, which is what, about $8,000 a year, right? $8K in cash flow per year. So what a lot of people will do, our real estate investors will take this $8,000 and they will, every payment that they get from their renter, they will use that to pay back this policy loan. So I think that's like $600 and some dollars, 670 or something like that. They'll use the 670 in cash flow from this property to pay back this monthly loan that they have. This is the loan from the insurance company. Right? So now every single month they're using the cash flow to pay back this loan here. And at each and every time it's simple interest, so it's going to accrue only on the principal and not on any kind of growth on the account, right? So we're paying a very low rate and we're paying down that principal each and every payment that we make, which is great. Most people go, okay, well, I'm making 8%. I'm only paying about 5% back in simple interest. There's a spread right there. That's pretty good, right? I'm making a few percent at least. But again, remember, we're making a compounding rate and we're paying back a simple rate, right? So that's good in itself because basically you had this money sitting around, you use it to purchase an asset, the asset spit off cash flow, the cash flow repaid the loan, right? Which is great. But the key point is, what happened to this $300,000? If this was sitting in your bank account and you took $100,000 out, where would that $100,000 go? Directly into that property. And then you have to spend 20 years slowly building back up that $100,000 investment you made. Where here you took a loan out, and what happened here to this $300,000? It acted as if the money was never taken out because it was a loan and not a withdrawal, which means that you kept that $300,000 in this account growing at 4 to 6% guaranteed each and every single year. So if 20 years it took you to pay back this $100,000 that you took out, what happened at $300,000? Well, some back of the napkin math will tell you $300,000 at 6% compounding growth over 20 years is how much? Well, roughly $963,000. That's what that at $300,000. If you never put another penny into that account, and all you did was just use it to purchase other properties, let those properties pay back the loan you took out, paying off what you owed in the property, and you let the entire lump sum here just keep growing, look at the growth you're getting here. Right? Over 300% growth because you let it sit there for 20 years and you used compounding growth while being able to pay back simple interest, right? Compound versus simple. This is the power of using this strategy in action, where it's a long-term play. It's not like you're getting rich overnight, but using your policy to purchase assets that pay down what loan you took out and allowing the original principal to never be touched and keep growing at a compounding rate gets you unbelievable returns at the end of the time frame. And you just let this keep going, right? So what does this look like at 30 years, at 40 years, at 50 years? This number is just going to get more and more outrageous in terms of the growth that's going to be there because of that compound interest. So if you're going to purchase property anyway using cash or using other people's money, think about what you're giving up, the opportunity cost by doing so, because you could be gaining an exceptional amount of wealth building by letting that money sit and grow at that compounding rate.